Hello and welcome to the second in a series of videos that relate to financial statements and ultimately into more intricate accounting matters. In the first video, we talked about basic financial statements and began with the income statement and balance sheet. In this video, we're going to move to a discussion about the statement of cash flows and notes to financial statements. I'm Roger Spain with Warren Averett. We're a CPA firm located throughout the southeastern United States. I work in our group that provides outsourced accounting, and I offer that to you just so you'll understand the perspective from which I come. Let's jump right in and get into the statement of cash flows and notes, knowing again that we talked in the last video about what financial statements are, who prepares them, who's responsible for them, and the balance sheet and the income statement. If you've watched that, great. I hope it meant something to you. If not, you may want to, instead of going forward with this video, grab that one first and come back to this one. Jumping right into the statement of cash flows then, let's talk about what that is. The statement of cash flows, in the first video, likened it to an indie movie in that it's similar to an income statement because it shows activity over some specified fiscal period. However, it's a little different from the income statement in that it presents some of the same information, but in a fairly different manner. The statement of cash flows shows how the company obtained and used cash for the fiscal period. The income statement shows revenues earned and expenses incurred during the period. The statement of cash flows begins with net income and then makes adjustments for activity that might not have had cash associated with that activity, or the cash may flow in a different fiscal period from when the expense was incurred or the revenue earned. When we look at the statement of cash flows, it's broken down into three categories. The three categories are operating activities, which are shown first, investing activities, and financing activities. What are each of those? Operating activities, if we look at a very simple one inventory item example, if a company sells, I don't know, tables, and it bought one table and sold one table, then the statement of cash flows in the operating activities section is going to show the results of buying one table and selling one table for cash. So it'll have cash out to buy the inventory and cash in to representing the sale of that inventory. When we talk about investing activity, here we're talking about investments that the company makes in activities that may not be operating. So a great example here might be a computer. A company may invest in equipment that it's going to need to generate revenues and going to need to conduct operations, but it's an investment, it's an investing activity, and we show that as a separate group second in the statement of cash flows after we've shown operating activities. Lastly, financing activities. These are activities that relate to how the company may have financed its operations or its investing activity. Here I use the example, if we talked about buying a computer or piece of equipment, if the company borrowed the money from a lender, from a bank, to buy that computer, we would show that as a financing activity. And likewise, when the company pays back the bank on that note payable to the bank for the purchase of the equipment, that payment back to that principal payment to pay down the note will be shown also in the financing activity section of the statement of cash flows. Importantly, the statement of cash flows reconciles beginning cash to ending cash. And that's how we know that it includes all cash activity for the company. Because if we start with the company's beginning cash at the beginning of the period, and then we show all of the activity, cash flows in and out, it should equal ending cash at the end of the period. And so that's how we know we've included all of the activity in the statement of cash flows. We talked about in a statement of cash flows, we begin with net income, and then we reconcile for non-cash items to allow us to present what cash operating activities were in the fiscal period being presented. So I've shown you now here on your screen an income statement for the fiscal period in question. And importantly is you'll see the most important line item on here is net income of $110. That's going to be the beginning point in order to determine how much cash we generated from operating activities in this company in question that I'm showing you for an example. The important thing in this video is not how we prepare cash flow, but rather what a cash flow statement tells us. I don't want us to get bogged down yet in how we prepare cash flow or how we conduct bookkeeping activities. What's more important for this video is gaining an understanding of what a cash flow statement shows us, how to read it, and what a reader of a cash flow statement might be expecting to see as they look at your statement of cash flows. So again, here we start with the income statement and net income on the bottom line of $110. We then talked about the fact that a statement of cash flows will show us other activities as well. Well, it'll show us operating activities as well as, we said, investing activities, and it will also show us financing activities. So here's the balance sheet at the end of the year. And remember, in the first video, we talked about the fact that the income statement shows activity for a period of time, and the balance sheet shows us a snapshot or a photograph of the company's financial position at a specified date, which is usually the last day of the fiscal period being reported on the income statement. In this case, when the company made $110 that we just saw on the previous slide, the net income number, we now see the balance sheet, which is the snapshot or photograph of the financial position of the company at that same year end. Here we see we've got cash, we've got inventory, we've got equipment of $700. That's, let's say, a computer that we talked about. On the right-hand side, we see that we owe accounts payable of $100. We have debt, and I'm calling that debt. It's where we borrowed money, probably from a bank, of $500. And in this case, I'm going to assume that in this case, I know that we borrowed that money to buy the computer. That's just part of the assumptions built into this model, so I can demonstrate this to you. And then finally, we have owner's equity and the balance sheet balances. And if that doesn't make sense to you, go back and watch the first video, because I think it'll be pretty well explained there. So now we go to the statement of cash flows for a fiscal period. We start, as I said, with net income of $110. We then look at the increases or decreases in accounts payable and inventory, and we show you those there. And here we're showing the reader that, well, the company bought additional inventory that perhaps it didn't sell, and it had to use cash to buy that inventory. So it didn't result in sales or cost of sales, so it's not included in net income because that inventory hasn't been sold yet. But that inventory was acquired with cash. So that means we had to use $200 to acquire the inventory that is shown on the balance sheet. So I'm going to flip back very quickly and show you that inventory is $200 at year end, and you see that. And so that means that, yes, we did spend $200 to buy inventory that's still an asset of the company, so it's not yet sold. Again, let's not get too hung up on how we prepare this statement of cash flows yet, but I want you to be aware of that's what these numbers represent. So we start with net income and we adjust for these changes in cash where we used or generated cash that result in activities that might still be on our balance sheet because they haven't made their way to the income statement, because they haven't resulted in sales in this case yet. We then show the cash flows from operations, which is the subtotal of that first grouping, cash flows from operations, $10 in this case. Well, that's great. What else did we do in the company for the year relative to cash? Well, we bought equipment we talked about. There was that equipment asset that was on the balance sheet for $700. Well, that cost money, so we had to buy that. That reduced cash by $700 because we bought a computer. Those were our only investing activities for the year. Well, what did we do from a financing perspective within the company for the year? Well, we did two things. First, we borrowed $500, most of which or all of which we used to buy the equipment that I just mentioned. So we bought $700 worth of equipment in this made-up scenario, and we financed $500 of that by borrowing money from the bank. So we received $500 from the bank. That's a cash inflow. And we show the outflow for the purchase of the equipment immediately above. We also, in my scenario, in the first video, we talked about the fact that the owner put $1,000 into the company. So here, just know that that's an assumption built into our made-up scenario where we're following a startup business through. But proceeds from paid-in capital, money paid in by the owners, was $1,000 of cash inflow. So the important thing I want the viewer of this video to get from this presentation is a cash flow statement shows cash activity, all inflows and all outflows, and it's broken down into three sections: the operations at the top, investing activities second, and cash flows from financing activities last. And when you total all of that up, we had a change in cash, positive change in cash of $810. Since our scenario here is a first-year startup, beginning cash was zero, our ending cash was $810. And if you were to go back on this video, you would see that on the balance sheet, it does indeed show that we have $810 in cash, so we balance. Let's now shift our focus very quickly to talk about notes to the financial statements. And once we finish that discussion, we will have finished discussing all of the four basic components of financial statements. Notes to the financial statements are an important part of the financial statement that sometimes get overlooked, and they shouldn't be, because they offer very important information relative to assumptions in the financial statements, as well as provide clarifying information relative to some of the very important numbers in the statements that we've been discussing. Common disclosures, I'll list these out for you, include, but are not limited to, accounting policies, tax status, fixed asset and depreciation accounting, inventory valuation, revenue recognition, debt and financing sources and costs, subsequent events, and contingencies. A great example of why the notes to the financial statements might be so important would include if a company were an unfortunate party to a lawsuit, then that might not show up on the financial statements anywhere else. And a reader of those financial statements might not understand that there might be a big, very material contingent claim against the company relative to a lawsuit. So reading the financial statements is where, or reading the notes to the financial statements is where a user of those financial statements would gain an understanding of such a contingency. So I want to encourage everyone to read financial statements. With that, we've now covered the four basic elements of a basic set of financial statements: the income statement, the balance sheet, the statement of cash flows, and the notes to the financial statements. And again, those are the income statement showing results for a period of time, the balance sheet showing a snapshot of the financial position of the company, the statement of cash flows showing cash inflows and outflows for a fiscal period, and the notes offering explanation relative to most of the numbers that are many of the numbers that are in those other three components to the financial statements. With that, we'll conclude this section on basic financial statements. And from here, we're going to start moving into some other maybe more tricky aspects of financial reporting, as well as ultimately getting into some of the ins and outs of how to actually prepare financial statements and keep a set of books. Don't worry, we're not going to get too mired in the details of that, but I hope this has been a great overview for everyone.